Good afternoon, ladies and gentlemen. Welcome to this month's MiPlan Podcast. We're talking about the pivot. There's a lot of discussion around where the Fed would pivot, but in this particular podcast, we're focusing on whether the markets are about to pivot. Quick update on the performance of the funds, and then I'm really going to dig quite deeply into the evolving narrative around central bank policy, focusing on the inflation debate, but more specifically focusing on how the current actions of central banks could lead to a tightening in the liquidity environment and how that would impact financial markets. And then I will share with you how we have positioned the portfolio from a slightly more defensive perspective. A quick update on performance. The funds continue to do very well. The green line at the top is the South African-based MiPlan Global Macro Fund. And then the red line is, since inception, the launch of the MiPlan Global Macro Fund in dollar terms. You can see that the fund has had a very good start to its journey, outperforming the global multi-asset flexible sector quite comfortably since inception in early March. That would be the relative performance. So since March and since the launch of the Dollar Global Fund, the South African-based Global Macro Fund is about 7% ahead of benchmark, and the Dollar Global Fund, pleasingly, is just under 5% ahead of global benchmark. I'm very happy to share with you that the South African-based MiPlan Global Macro Fund passed its 10-year anniversary in May of this year, and pleasingly it is solidly first quartile over all measurement periods from 1 month to 10 years. If we have a look at the current macro environment and we take ourselves back to the start of 2022, the narrative at the time was one of expectation of a recession. Inflation would decline. The Fed would get to a point just under 5% and would pivot. In fact, many saw the peak of Fed funds rate at no more than 4.5. That earnings would collapse in the S&P 500, with many of the leading houses calling for sub 3,500 on the S&P. And so what went wrong? The narrative was almost completely incorrect. And so if we look at it today, we see that inflation in many countries, the black line, is abating. China inflation is virtually non-existent. US inflation is just a touch below 5%. And the debate really is about the sticky part of inflation, which, as you can see from the pink bars, is mostly reflected in services component. And the other component that is particularly sticky is the rental component in the US market. That's perfectly illustrated in the next chart, where you can see the rent of shelter making up a significant part of current inflation, and that indeed is expected to decline in the months ahead. The inflation shock that was brought about by the invasion of Ukraine, the surge in energy prices, has had a knock-on effect on wages. You can see that in the UK, wage rates are now running at about 7% year on year. In the EEZ, the Eurozone, at about 4% year on year. In the States, they are abating somewhat, but still sitting well above what the Fed feels comfortable with. And so the Fed continues, as we'll show in a chart or two's time, to remain in very tightening mode. But I think the real agenda behind the Fed's rate hike has been the re-establishment of real interest rates. The Fed has had to do two things primarily. It has had to drain a lot of excess liquidity from the system, and it has had to re-establish real interest rates. It has done the latter and is busy with the former. Having real interest rates back to levels just post the global financial crisis is a very important buffer for the Fed, as it allows it some maneuverability in policy as the US economy starts to slow. What we see from a number of macro indicators, this one happens to focus on US retail sales, is that growth is indeed softening. The higher interest rates are having an impact on US consumer disposable income. Households are finding it a little bit more expensive to pay off the debt that they have. Mortgage rates have risen, cost of credit's gone up, cost of food's gone up, cost of energy's gone up, and as a consequence we see a slowing in general demand patterns. We've also seen a tightening in lending standards, the solid line on the screen, and with that often comes a decline in manufacturing. An interesting way to look at the outlook for growth in the US is to follow an unusual indicator, something called the cardboard box recession indicator. And this is just simply an indicator that tracks the rate of change in industrial shipments of corrugated boxes from a year-to-year basis. And the logic is that these days the US economy, which is comprised of around 65-70% services, is less prone to demand-driven shocks from the consumer, but nonetheless manufacturing as a segment of the economy and the increasing geopolitical tensions with China make the cardboard box a lot more interesting to see what's happening in the real economy. So our general expectation is that as we go into the second half of this year, growth in the US will slow, and it will be seen in the jobs market, weaker jobs market. It will be seen in lower wages. It will be seen in the demand side softening up. Retailers and manufacturers expecting softer demand will reduce inventories. It's really just a question of the extent of the slowdown that's more important to consider from a market perspective. So how are financial markets responding? Quite predictably, in a strange sense. The chart shows you what equity markets, the S&P 500 in particular, has traditionally done post the peak in inflation. We're now well aware that inflation has peaked, and you can see that the black line, the S&P 500, has almost in a scripted fashion followed the median of market returns. The reason why the S&P never collapsed into a bear market was very simply that earnings didn't collapse. And as we've shown in previous podcasts, equity markets are typically divided up into three phases of a bear. The first phase, where you do get a minus 20%, is normally attributable to an interest rate reset that we did have. So at a very technical level, you could argue that the first phase of a bear market has been completed. But very importantly, to transition to a full-blown bear market, it's rather dependent on earnings declining. And we had not seen that at this point, nor had we expected it. We do think earnings itself will revise slightly softer in the months ahead, but as you can see from the chart, we're not expecting a collapse in earnings, and the peak that we're expecting in interest rates is likely to act as something of a buffer for further market derating, particularly with the US long bond moving slightly stronger. I do apologize for the complexity of this chart, but it does illustrate the key point of this podcast very nicely. It is slightly technical, but I will look to unpack it for you. In the top panel, we have the gold-colored line, which is a proxy for liquidity. That essentially is the New York Fed's balance sheet, excluding certain technical instruments like reverse repos. And the teal-colored line is the S&P 500. And common feature over the last while is that equity markets, have been reasonably correlated with liquidity. So the rally this year, against all expectations, has been a function of Fed balance sheet expansion as the Fed pumped liquidity into the market along with the Bank of Japan, along with the ECB. That liquidity surge has been quite instrumental in pushing equity prices higher. The question is where to from here. We're all familiar with the fact that the US has recently come off a debt ceiling. The Treasury account that is held at the Fed had drained from around 1 trillion down to as low as 50 billion. And Janet Yellen now has to replenish the Treasury account, top up the tank, so to speak. The question is, where will the money come from? At the moment, there's about 2.1 trillion sitting in something called the reverse repo account. This is a facility set up by the Fed to allow individuals and money market funds, more specifically money market funds, to place their funding with the Fed at a very attractive rate. But Yellen also needs to attract money by issuing treasury bills. And it's the bottom panel that holds the key. For Yellen to be able to top up the treasury account back to 1 trillion, she is going to have to source that money from somewhere. If it comes from money market funds, there will be no difference in the liquidity. If it comes from individuals or banks who are seeking to take advantage of the higher yield, then it will drain liquidity from the system. And that really is the key point to focus on for the next 6 months, is how the Fed manages that relationship. If we take it into the market's pricing of interest rates along the yield curve, the top line, the black line, shows you the current yield curve of the US. And it is quite interesting that the short end is offering a materially higher yield than the long end. What is our interpretation of this? It's very simply that the Fed is keeping financial conditions very tight. It needs to create an incentive for funds to flow through to its own balance sheet, simply to reduce liquidity from the system. And in a sense, it's now in competition with the Treasury, who also requires funds, and the extent to which the Fed manages that balance is going to be rather important. What the long end of the curve is telling us is that inflation is coming down. The market is quite comfortable with this. And for any of those that are listening to the podcast that are interested, just Google the Fed's Conundrum. It was a paper published in 2006 after Alan Greenspan had raised interest rates about 17 times. And the bond market kept on dropping yields while the Fed kept on raising yields, for a clue as to how this market is interpreting current Fed policy. In terms of our own asset allocation model, we have a simple risk metric which looks at the spread on the yield curve on a rolling 2-year basis, compares it to the volatility index, and in essence we do not see at this point in time the indicator moving towards a deep recession, but we're very conscious of the fact that volatility is too low, and if anything, the Fed's very tight monetary policy that you saw on the previous slide is going to create the conditions for the economic environment to slow quite quickly. Why is that important? We reiterate this chart. In this sort of environment, long duration assets do very well. We've seen an explosive growth in tech stocks since the start of this year. It has left many a research house, a little bit baffled, given the fact that they were expecting the market to move into a recessionary phase. And so we're cautious, having been very well positioned, as you saw in the performance of the fund, for a long duration play. We're monitoring very closely to see whether we move back into more of a contractionary phase that was rather more characteristic of 2022. So in conclusion, we believe central banks will remain restrictive. The US in particular has to slow growth. It has to slow the labor market. We're not worried about inflation, sticky or otherwise, that will decline. And we think where some of the breathing space may start to come in is that real rates, having returned to around 2008 levels, will act as a little bit of an underpin for Fed policy going forward. So we expect equities to remain in a steady state for now. We think the market will start to rotate into more defensive and value stocks as the economic growth slows, and we're a little bit mindful of the fact that we are mindful of the fact that PE multiples on stocks like Nvidia have moved to fairly high levels, and we would be looking to take further profits on any weakness. Thank you for your time this month. I hope that has been useful. Thank you.